Hey everyone, welcome back to The Graducator, where we make finance fun and easy to understand. Today we're diving into the world of revolving credit facilities. Now, don't let the fancy name scare you off. It's a lot like a credit card for businesses. Intrigued? Let's get started. Okay, picture this. You have a credit card with a $10,000 limit. You can make purchases up to that limit, pay it off, and then spend up to $10,000 again. A revolving credit facility works the same way, but for businesses. So what exactly is an RCF? An RCF is essentially a pre-approved loan amount that a business can draw from whenever needed, repay, and then use again. It's perfect for managing cash flow, covering short-term expenses, or investing in opportunities. Let's break down the key terms of a revolving credit facility so you can understand how it works. Let's start with the facility limit. This is the maximum amount of credit available, say $50 million. Now, when you borrow money, you pay an interest rate. For bank lending, this is usually a margin plus a reference rate. For example, 250 basis points plus US Treasuries. Remember, 1 basis point is 1/100th of a percentage. So 250 basis points is 2.5%. And if you don't know what a reference rate is, don't worry, I'll be sure to cover these in another video. Now, interest is only applied to the amount you are spending, but for the remainder, there's a commitment fee applied, which is basically a fee paid to the lender for holding the remaining credit available as they can't lend it to anyone else. This is usually a percentage of the margin multiplied by the undrawn loan amount. For instance, if we have a $50 million loan and only 20 million had been used, the commitment fee would be calculated as 40% of the margin. If the margin is 2.5%, then this means the commitment fee will be 1% of $30 million. And if you use more than 30% of the facility limit, you might pay a utilization fee like 0.1% per annum on the daily outstanding balance. Next, we have the maturity date, the date by which all borrowed amounts and any accrued interest must be repaid, often something like 5 years from the start. Need more time? There might be extension options available, but that usually comes with an extra fee. Wondering how to access the funds? Well, the drawdown mechanism outlines the process for this. You might need to give at least 3 business days notice to the lender to draw funds. Then there are repayment terms. These are conditions for repaying the borrowed amount, usually at maturity. And the revolving feature lets you reborrow amounts that have been repaid as long as you don't exceed the facility limit. Now, let's talk about covenants, which is a fancy way of saying rules or conditions that the borrower must comply with, such as maintaining a debt to equity ratio not exceeding 3 times. If a borrower fails to comply with the rules of the covenants, then this may trigger a default, which means the facility might be terminated. Last few bits, security is any collateral provided by the borrower, such as a first charge on an asset. The governing law specifies the legal jurisdiction, say the state of New York, and notices are formal requirements for communication under the facility. And there you have it, the key terms of a revolving credit facility. Now, here's a free quiz that will help you test your knowledge and consolidate what you've learned. Just click on the QR code, or you can find the link in the bio. Please remember, if you found this video helpful, make sure to subscribe and hit that notification bell so you never miss an update. Got questions or topics you want to learn more about? Drop them in the comments below. See you next time on The Graducator. Thank you so much.